Right now, let's get a sense of when to know whether it's buy or just sell any potential minor rally or not as big decline. Matthew McAleer joining us now. Matthew McAleer is Executive Vice President and Director of Equity Strategies at Cumberland Advisors. Matthew, just giving you a sense of where we're at. I mean, minute to minute, it changes a lot, but the S&P down 6.3% right now. Do you view this as a sign that everything has changed, that we are indeed heading toward a recession?
Well, in terms of the recession, way too early to tell on that. And obviously the term oversold gets thrown around probably too often. But there are some panic levels that we're hitting here that we haven't seen since '08. And, we're paying an awful lot of attention to. If you have cash, if you've had raised some cash in the past, if you have perhaps bonds that are, with a 10-year at 70 bips, that perhaps you want to start to take a little profit there. I don't think you can ignore the fact that we're probably looking at an equity-only put-call ratio through 1 for the third day this week. Back in '08, back in '01, '02, back in '98 when I was early trading, if you got 2 equity-only put-call ratios through 1 in a span of 5 days, it was cover all shorts and get some cash to work. We're probably going to hit 3 today, that being Monday, yesterday, and today. So I think you can nibble here, pay an awful lot of attention to good relative strength names that had to be pried out of sellers' hands, names that are selling above those August pullback lows, names like Microsoft, Costco, Lilly, Adobe. If you want to stick to the indexes, stick with the Qs. Don't get cute. Qs trading above August lows, even with this damage. So those are the type of things we look at.
And I'm wondering, just to get a sense of the actual technical operations of the market, since we are seeing the New York Fed step in, and as much as this is simply to flood banks with as much liquidity as possible, as companies draw down on their credit lines, and more of just sort of a financial functioning type of move, there does seem to be some sort of effort to stimulate things. I mean, do you have a sense that it's easy to get in and out as you operate, or is it hard to make trades at the levels that you're seeing?
We haven't had a liquidity problem. I think I know there's been some tightness in liquidity in the high yield market or in the high yield muni market. On the equity side, we've been in pretty good shape. Keep in mind we're primarily large cap. There's plenty of juice out there on both sides of the bid and the offer.
All right. And going forward, what's your time horizon? Because in other words, people are saying, you don't want to catch a falling knife. This might not be the bottom. Sure, it might not be the bottom. But if you have a constructive view of, the economy going forward after this period, then, people are saying it might be a good time to buy. What's your time horizon?
I think it breaks down if you're a short-term trader or longer term, or if you're an investor that keeps some money in a short-term bucket and other long-term. I think short-term here, again, at some of those extreme levels of panic, I think you've got a nibble here. Longer term, you probably haven't sold much, so perhaps you don't have a lot of cash to put to work. I do think in the past on these virus-type pullbacks, and we've had them before. This is more extreme, more downside. But go back to SARS, go back to swine flu. You've had some pullbacks. They've been short-lived. The pullbacks have been 3 to 6 months, gotten past that, real virus headache, look through the valley a little bit. So, consider nibbling here. I think in terms of risk-reward, decent level, decent spot here.
I'm just wondering, though, if there is some sort of recession which is priced in, if not, some people saying we may already be in one, considering the fact that people are expecting a contraction as a result of the coronavirus-induced slowdown. Do you stand by this call? In other words, do you expect this to be a 3 to 6 month disruption versus something longer?
Tough to tell. And keep in mind, we don't trade recessions. Right? We trade securities, we trade equities, we trade bonds, we trade commodities. You can't line up a market on top of a recession and trade it well. So you're pricing in a recession right in here. How nasty, how deep that recession is, that's that's not something I'm even concentrating on. I'm trying to look at reasonable risk reward at different levels in different securities that we want to own. And the flip side of that is in securities we don't want to own, we want to upgrade the portfolio. So if there's some names that have been battered, that doesn't mean that we go to those names. We may have to sell those names, sell those indexes to upgrade to higher quality. That's something that sometimes gets overlooked.
Matthew McAleer, Executive Vice President and Director of Equity Strategies at Cumberland Advisors. Thank you so much for being with us. Coming up, we do have more on the markets, in particular the repo operation that occurred right now in the market. We're seeing the losses re-deepen. The S&P down now 7.4%, the NASDAQ down 7.1%. The S&P 2537 points right now we're looking at. Coming up, we've got more. We've got bid into bonds. Gold still selling off. This is Bloomberg.